Kia ora and welcome to Deep Dives with Will and Reubs.
A show that is making accounting cool again.
I'm Will.
I'm Reubs.
And today we are looking at metrics that matter.
That's right. So in this session we're going to be focusing at the things we should be measuring in our businesses, looking beyond the P&L, beyond the balance sheet, and looking at what we should be measuring, how we should be measuring it, and why that's important.
Yeah, so in the accounting world, we're moving away from just doing the bookkeeping and doing the debits and credits and into more of an advisory type world. And Rubes and I believe that if you're doing advisory, it's important to know what numbers we should be looking at because these are the numbers that drive the performance in a business. So we want to be able to take you through these, how we track them, and what sort of decisions we can make from these numbers.
What metric are we measuring today?
So actually what we're looking at today is not a metric as such, but we felt it fits into this topic quite nicely, which is retentions. We think it's important that everyone understands project retentions. It's a big part of the construction industry. So we felt that we could kick this off with retention claims.
I can't wait. But before we get into it, we're going to have our quote of the week. And I understand you've prepared something earlier.
I have. So the quote this week is from David Goggins. So David Goggins is a bit of a he wouldn't like being called an inspirational person. A psychopath. Yeah. He was a Navy SEAL. He's known as the hardest man alive. Navy SEAL, ultra marathon runner, and has completed a huge list of achievements.
Yeah.
Exactly. So he's written a book called Can't Hurt Me, with the help from an author who did a very, very good job at articulating I suppose David's life and what he's achieved and his mantras that he has. So the quote I have is, very few people even bother to try to control the way their thoughts and doubts bubble up. The vast majority of us are slaves to our minds.
That's pretty heavy.
It's heavy, yeah. The book is very heavy. It's a fantastic read. So a lot of the book is about understanding the human mind and the limitations that we set on ourselves in all sorts of areas, one being physical and the other one being mental in terms of setting a goal and then when things get hard, giving up. And what David Goggins does very well, better than anyone in the world, I imagine, is being able to push through those that self-doubt and push through the pain barriers and that suffering to achieve what he sets out to do for himself.
Absolutely.
So what this quote means to me is that through reading David Goggins' book and learning from that, and then I suppose going and applying some of the lessons to my own life, and Rubes has also read the book, and that's what inspired our first marathon. We've got another one coming up very soon. Yep. And what I sort of took from that is that when you get to the point where your mind is breaking, so that could be in let's say you're running and you hit K30, K35 and your body's breaking down, well, the whole time you've got this chatter in your mind that's telling you you're doing serious damage to your body. You need to stop now. The chatter says things like, "You're not David Goggins. You just read his book. You don't have to complete this.
No one will know.
Yeah, you have not had enough fluids. No one will know." So these are the thoughts that start happening in your mind, and then this is what you learn to understand, that there's this chatter in your mind that's always trying to take you down the easy path and the comfortable path. But then there's also this awareness that you have that knows that no, I can push through this. I can continue, and it's about being aware that there's multiple voices in the head, and it's about quietening that voice that's making you try and take the easy route and sticking to what you set out to achieve. And that I find that doing this in the physical realm, so running marathons, lifting weights, practicing yoga, all of these things that we do, that transfers into the business world as well, because there's things like we've had some seriously big challenges over the past few months in terms of the code that I'm writing and just things happening in business and cash flow and all those sort of challenges that arise, managing a team. Anyway, there's times where you feel like this is too hard, but you learn through the discipline that you learn through your physical feats that carries through into business, and then those things don't affect you as much as they would if you trained your mind to give up. When you train your mind not to give up no matter what, that sort of carries through to every other aspect of your life.
Totally. One of the things I like that David Goggins has to say is about motivation. He says you can't just rely, self-help isn't that helpful because you're not going to be motivated every day. Motivation is something you need to conjure up inside yourself, and no matter how high your levels of motivation, no one can maintain those forever. So what you need to control is that discipline. Discipline wins every day. Motivation waxes and wanes like the moon. Discipline is continuous. If you can master that within yourself, then you'll be able to achieve a lot more than what you think you can.
Absolutely, yeah, and it's that practice as well. Just constantly practicing discipline, and that's where I think
it's a muscle.
It is. Yeah. Discipline is a muscle of the mind, and so not yesterday, the day before, I was in Whakatane, and I ran to Ohobi Beach over the mountains. So it was a 360 meter climb, 20 k's. Took me 2.5 hours. I did it with no water. It was really, really hard. I was broken. My feet are not in a good state at the moment. I'm in a brand new set of shoes. But it's going through those pain barriers and constantly pushing through those pain barriers where you start to train that muscle. And that's what a lot of people say is if you can train yourself to be disciplined in the physical world, being exercise and pushing through, that transfers into getting out of bed on time and finishing the tasks you set yourself throughout the day. So David Goggins' book Can't Hurt Me, it's a fantastic read, and I certainly learned a lot from it, and Reubs, I think you did also.
A lot more than what I expected, definitely. There's a lot of self-help books out there. It is not a self-help book. It's almost the opposite. It's a self-discipline book.
Absolutely. It approaches it from a completely different perspective. So enough about our man Goggins, and should we
retentions?
We're talking retentions.
What are retentions?
Retentions are. Let's look at an example. So they occur in the construction industry.
Okay.
Right? So in the construction industry, if you look at any other industry, you send someone an invoice for the work you've done, and then they pay that invoice because you have delivered the goods or services.
Yes.
In the commercial construction space, particularly, it works a little bit differently because there is, a lot more risk when you're building multi-million-dollar commercial projects. So what we need to do is ensure that the workmanship is up to standard. Now, when you send an invoice when you have a contract to build something in the commercial construction space, what often happens is there is a clause there that the customer can withhold retentions on these claims. So let's say we are building a $10 million property development in a commercial environment. And the reason I keep saying commercial is in residential, this doesn't always happen. It's quite uncommon to have retentions in the residential world, but in commercial, very, very common. And it's important to understand. So if we're doing a $10 million commercial build, what's going to happen is you'll have set out in the contract at what stage you can make your claims. So for example, plans are drawn up, there might be a 5% claim, and then foundations laid, 10% claim, and then framing has gone up, 5% claim. So as you work through this project, you can claim stages of the projects, and as the construction company managing that project, what you need to do is you make that claim, and then you need to pay your suppliers for the materials and for the labour and for any other consulting services. So when you're making these claims, what happens is you send let's say 10%, right? So if we're making a 10% claim on a $10 million project, it's $1 million claim.
That's right.
So what I would do is I'd send, let's say, Reubs, you're the customer. I'm going to send you an invoice for $1 million, but I'd also include a line in there which says less retentions held, which is, let's say it's 10%. Now these percentages do change depending on the size of the construction project and at what stage the claim is. So it is. I'm going to use 10% just to make my numbers easy here.
That sounds good.
So when Reubs receives this invoice, he'll have $1 million claimed, less 10% retentions held at $100,000, and that's going to give us $900,000 invoice to pay. So he'll pay that invoice of $900,000. Now, as we work through this project, we're going to be sending these invoices, less retentions held, and then we're going to get to the end of the project, and we're going to have 10%, let's say, for keeping things simple, 10% of that project value has been withheld by the customer for 12 months. Now, the reason we do this is we want to make sure that the workmanship is up to standard. So once we've hit the 12 months, we can then start claiming the retentions back. or what it's called is Reuben will release the retentions. Now, in the commercial construction space, generally 10% is the margin you make on a project. So the building company will make margin if the building company has internal labour, it's going to make margin on the labour it is selling, but it's also going to make a 10%. Generally, it's 10% margin on the construction value. So for a $10 million project, you're expecting outgoings of about $9 million. So what's interesting there is that 10% is actually the profit. So the construction company who's managing the project doesn't actually see the profit on that build until those retentions are released 12 months later.
Yeah, that's right. So the whole time you're sending these invoices, you may basically covering costs until
you're covering costs.
Point. Yeah. How long is a retention period typically?
It's generally 12 months. Generally 12 months once the construction is finished.
And 10% is an example used here. What would be a typical retention percentage?
Sorry, what was the question?
What would be a typical retention percentage that you'd find on a commercial construction contract?
So generally it's 10%. I can't tell you the exact figures, but I believe it's 10% up to 250k, and then it drops to maybe 7.5%. Yeah. So the larger the project, the less the retention is. So I can't quite remember the exact percentages.
It's very contractual. It's not
correct.
Yeah. So it's unique to the build, unique to the customer.
That's right. Yeah. So I believe under the Constructions Act 1993 or whatever it is, that's in New Zealand anyway. It's all outlaid in there, unless contracted otherwise within the construction contract. But anywhere else in the world, they may have a similar situation. So what we're trying to do here is not explain the absolute details of retentions. We're just trying to give you a bit of an understanding of what a retention is. So if someone says, "Oh, we have retentions," at least you can go, I know what retentions are.
Great.
And you have a good idea about how they actually they work, and you understand that what you're doing is you're doing progress claims, and a percentage of that fee is withheld by the customer until the project is finished. That's the key thing we want to communicate here, is what they are. So if you do have a client that's talking about retentions, you don't sit there going, "Oh shit, I don't actually know what retentions are."
Yeah, well now you do. What that creates is something quite interesting, because we're sending an invoice that has a revenue line item on it of $1 million, for example, for progress claim number 1. And that has a negative line item on it for a negative $100,000 to make the total accounts receivable $900,000, which is the amount the customer should be paying us, which is great. But now I have this negative line item. Now, that's a current asset to me, isn't it?
It is, yeah. So let's say I am the building company, you are the customer, and I've invoiced you the full 10 million, less the $1 million of retentions. Well, I've actually recognised $10 million of revenue, and now I have an asset sitting here of $1 million, which is
current asset. Yeah, one of my customers is hanging on to for me for the next 12 months. But once the building's all ticked off and it's all good to go, I'm going to get that money back, because it is owed to me. Yeah,
so is there I mean, we're getting quite deep into the accounting now, but is there a journal that we're doing at year end to recognise that asset? So let's say I've recognised $10 million of revenue, but that's not all revenue, because I've only got $9 million of actually received. So that creates a tax liability for us at that $10 million, even though we've only really in a way invoiced $9 million. So do we have some sort of auto reversing journal that we put through at that stage?
Not in my experience, but yes, you could. Most people that I see, they generate their invoice for the total value of the sale, which is debit accounts receivable $1 million for that line item, credit sales $1 million, that's our revenue, and then they've got this negative line item, and that what they debit there is a current asset. However, because it's a negative line item, it's actually they debit the so it's on the as a negative $100,000, for example, and it's going to a current asset account, but because it's on our invoice, it's going to increase that current asset. So instead of it's writing down our accounts receivable to $900,000, that's the total value of the accounts receivable, but it's writing up the current asset to retentions account. And that just builds up in their Xero or their accounting system, whatever they're managing, and it's up to somebody either monthly or some frequency, because you're going to have these entries that are occurring basically every month for all your builds. It's not just the one build you have on, it's every one of them. And so you need to be looking back at this balance that's just increasing. It's not in your accounts receivable. That's very easy to watch. but you've got this whole other account that you need to be paying attention to that's meant to be reminding you about these jobs you did a year ago.
Yes, the asset being retentions held.
Yeah, correct. Yeah. So you need to be paying attention to that and watching it grow, because we'll be growing, and asking yourself, when are these due for release, so that you can then generate a new invoice to cancel out their
for
retention.
the 10%
Correct.
remaining.
Yep,
Yeah,
that's
totally.
Right. And that'll recognise the revenue on that date.
Yeah, right. So I suppose
that's the tax liability occurs.
Yeah, that's right. Yeah. So I suppose it comes down to what accounting logic you want to use there, whether you are looking at doing an auto-reversing journal, because what you could do, and I don't know whether this is what people do or not, but you could look at doing an auto-reversing journal to take that, let's just say $1 million that's sitting in retentions held. You could do an auto-reversing journal to journal that into your sales, or maybe a separate sales code, which we could call retentions held, which reduces our revenue by the retention amount, removes it off the balance sheet, and then reverse it back out again at the start of the next financial year. And then what we're doing is we're reducing our revenue that we've made in that accounting period, which reduces our tax liability. So that's one way you could do it.
Yeah, totally. Yeah, I've also seen different methods of managing retentions. Not everybody takes the retentions throughout the life of the job. I've seen some people who only invoice the retentions at the very, very end. So they'll be fully claiming everything as they go, and then at the very end of the project, they'll send a final invoice that will be for the total retention value, the whole $1 million.
Gotcha.
Yeah, so I've seen that happen as well. A lot easier to manage that way, because you don't need to keep track of all these. The complex part about this is that it's not $1 million every month. It's always a percentage of some value that's been delivered. So keeping track of the total retention value when it's changing every month is very difficult.
Do you know what makes it even more difficult? Is what we've got is so we took a really basic example before where we said we're making a 10% claim, which is $1 million, and then we withheld 10% being $100,000.
Yep.
So $900,000 would be the invoice total. Now, what makes it more complicated is you have a claim schedule. So the claim schedule and the invoice is different. So the invoice said, the 900 grand total. The claim schedule, on the other hand, says we are claiming this phase here, which is foundations laid. So you put the claim schedule through to the customer. Let's say, Reubs, you're the customer.
Yep, I accept that.
So I've claimed that, and I've sent you the invoice as well. And then what you'll do is then you'll come back and go, I disagree that you've finished this. So then in my claim schedule, I've claimed the full amount, but then you only release a percentage of what my actual claim is, and then the retention's off that. So then that's another thing that they need to manage, especially in these really large construction projects, because the customer's pushing back as hard as they can, saying, hey, you might think that you're claiming this stage, but we're only going to give you 90% of that stage, and then we're only going to give you that percentage of the retentions will be held. So then there's this whole other complexity around the claim schedule and then the invoice totals, and then that's
something very, very unique to the construction industry, is the whole idea of a progress claim. It's not it is a financial document, but it's not an invoice. So the claim is what you're claiming against the job. A claim gets approved by the customer or a quantity surveyor, or it gets agreed where somebody will actually physically walk around the site and go, well, here's what you say you've done. Has it been done? Yes, 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 no, no, no. And all those yeses, they get put on an invoice, and all the no's don't. But the problem is when you do your claim and you do your retention, you're calculating it on the best case scenario, basically, which is that you have done everything you said you're going to do. But the invoice that gets generated may not be on that basis.
Totally, yeah, and that's the game of the construction space. Is there's a $10 million build that's happening, so that's the pot of money. There's $10 million on the table, and then you've got the architect, you've got the engineer, you've got the project manager, you've got the building consultants, you've got all the materials. Everyone's sitting there, and everyone is trying to get the most amount of that $10 million possible. And what happens?
On time.
Sorry?
On time.
On time, yeah, exactly.
Yeah, they've got wages, they've all got materials they've purchased.
Yeah, and what happens is we have variations and things go wrong. So when things go wrong, it gets into this giant shit fight of who takes responsibility for that. So that's another thing that happens in the construction space, which is quite unique to any other industry, especially, again, I'm just coming back to the commercial construction space. Residential is a bit more friendly, I think, but in the commercial world, it's pretty cutthroat. Everyone's out there to try and get their biggest piece of the pie, and then anything that goes wrong, it gets in. Everyone just basically turns up in a boardroom and fights until someone figures out who's going to be wearing the cost.
Pretty much. Yeah, totally. It's pretty ruthless. And as an accountant advising an industry like that, they're dealing with very tight margins and high dollar values. How do you run a business on a 10% margin? Well, do 3 or 4 $10 million contracts, and you'll find out how. Like they're actually dealing in. They can do very well.
Yeah.
Provided things are managed they know their numbers very well.
That's
However,
right.
when they don't, and the costs start slipping, then or retentions get forgotten or not claimed or not calculated correctly, then they start losing money very quickly.
Yeah, keeping track of retentions is so important.
So you should be seeing it somewhere in your balance sheet, I believe, as a current asset, saying this is the money that's owed to us but is not yet invoiceable until this date, because we have done the work. We just have not had the right to invoice it just yet.
And it's also worth doing some research around the treatment of those retentions when it comes to financial year in terms of the tax implications. I've just mentioned 2 possible scenarios. One is you leave the retention sitting in the balance sheet and you pay the tax on the full 10 million from the example we were looking at before.
Yep.
Or you do an auto-reversing journal to pull $1 million out of the balance sheet as a negative revenue entry to reduce your revenue for the period, reducing your profit, thus reducing the tax liability. So there's 2 treatments there, and I'm not going to be the one to advise on which one is the right one to do, but have a chat to your client, have a chat to other people, and find out what the best treatment is.
Totally, and for the country that you're in as well, you may actually have some specific legislation around this. But another method I've seen is where you invoice the full value, $1 million for the claim number 1, and the customer just short pays you deliberately, and you know this. So that the customer's going to short pay you. The customer knows this because you agreed it. They pay you $900,000, so you have it, come into your bank account, and what you then do is generate a credit note at that point, or the date of payment, to recognise the current asset that's owing.
Or you can just leave 10% of the invoice unpaid.
Correct.
And then send a bunch of unpaid invoices 12 months later.
Absolutely, you can do that. So you have a statement that's just got heaps of short paid invoices growing on it, and then you'll never forget about those retentions because they're sitting in your accounts receivable. That's right. Yeah. The downside of that is that your debtors can be quite misleading, because you look at your debtors and you're like, oh great, we've got $2 million worth of debtors, but most and 80% of that might not be due for another 12 months, but it's the invoice date will say 7 days or whatever.
That's right. And I find the bigger the construction company, or the bigger the contractor, the more complex the management of the retentions are. If you've got, like, let's say it's just like a little plumbing company, 4 guys, and they get the odd construction contract, commercial contract, they're going to keep them really, really simple and just probably send the invoicing, just get 90% of it paid. Whereas if you're getting into these like larger companies where they've got a workforce of 50, 100 guys, that's where they're going to have a really, really clear process of managing retentions, because they're going to be getting a bigger piece of that pie, essentially. So, it's important to understand. I mean, your client will also have an understanding of retentions as well, so have a discussion with them how that works.
Totally.
Yeah, so retentions.
That's what retentions are. That's how they are calculated generally. What can we use them for? I've seen the different places we can either see them, in our accounts receivable. We can see them as a separate current asset, or we can invoice them at a much later date. Those are kind of your 3 going options. Was that all we needed to cover around retentions?
They're a pain in the ass.
We should also touch on variations. We'll cover variations in a separate episode, perhaps. But variations are a change to a construction contract we just described, where there might be, maybe you want to do an extra floor to your building, and that'll be a variation, and that may or may not have some retention on it. So that adds another layer of complexity to that invoice you're sending. You're not just sending an invoice for $1 million progress claim 1, because that's the original plan. You're actually sending an invoice for $1 million plus $50,000 worth of an extra building or floor, lesser retention. So that's as you can see, that can get quite difficult.
They are complex. As I said, they're a pain in the ass. Retentions. No one really gets really excited about managing retentions. They're quite an administrative drain
on everybody.
Yeah,
the person withholding them and the person issuing those claims and invoices.
That's the other point, is you got to think about this from the customer's perspective as well. If you're let's say you're the electrical company invoicing the main contractor, they are withholding retentions on you, and then the main contractor will also be having invoices to the client who will have them held on him or her. Right. So it's all flowing down the train chain. It all flows down the the chain.
Totally. Awesome. Okay, well, that's it on retentions.
I hope that it doesn't all make sense, obviously, because it's really a complex topic, but at least I hope that's given you some insight into what retentions are, and at least you can have a good conversation with your clients.
Yeah, totally. When they mention this word retentions, you won't be in the dark about what they are, how they're calculated, what they're for, and what our options are around reporting or displaying those or managing those.
Yeah, right on. Awesome.
Okay, so that's it for Metrics That Matter this week. We're going to see you in the next episode, which is failures and fuck-ups.
That's what it is. Yes, we'll see you guys then.
See you then.